So now we're moving forward. We've had overview, we've had accountants, we've now had actuaries. Now we're moving into the AASB. Who we blame for all this? Perhaps not. But so I'm looking forward to some real grilling questions to be coming through the hotline soon. So with that, I'll throw over to you. Thanks, Kris.
Thank you. Well, with an introduction like that, I feel like I should have my shield up. But I was going, can I answer the previous question, please, as to why we're actually introducing this standard? So the good news for you is that we're actually not going to have a technical session in this piece. What I'm going to try and do is explain to you why the standard is actually coming out and what do we still need to do to actually finish off this standard. So just before we get started, I just want a quick show of hands. Who works for an organisation who only deals with Australian clients? So there's a few of you. Okay. Now of those, how many of you don't have reinsurance that's an international piece? Who gets their reinsurance from solely within Australia? Nobody. So we are all exposed in some way internationally, aren't we, is really what that little question was getting at. So why are we actually introducing IFRS 17, AASB 17 into Australia, is that we need to make sure that we're actually disadvantaging you in Australia as a result of what's actually happening internationally. Now, we've been at the forefront of insurance accounting. So we've had fair value accounting here in Australia for many, many years. And funnily enough, when that first came into Australia, the AASB had its first legal challenge, and so actually had to go to court to say that that standard could actually be implemented in Australia. Funnily enough, the entity that actually took us to court at that time, when the ISB started having its conversations about what should we do internationally, they came and said, please don't take away fair value accounting. So, big change in concept, and that's why it's such an important role for us here in Australia. We need to make sure that we're selling the benefits of fair valuing your insurance liabilities internationally, because we've been through a lot of the pain. So from our perspective, we're ahead of the pack. Now, it might not feel like that at the moment, but that's the reality. And when you think about what is happening internationally, it's a dog's breakfast. It really is a dog's breakfast. So you've got some people that are still doing historical cost accounting for their insurance liabilities. So how valuable is that information? Not at all. And that's what users are saying. We're desperate. We need something that's going to help us understand what insurance is about. Now, next question for you. You're all insurers in the room. How many of you can go home at night and say to your family, guess what I did today? And let me just explain to you what insurance accounting is all about. Who thinks they can do that easily? Yes? No? I'm not willing to answer that question. Okay, reality is users tell us that they see insurance as a black box. They have no clue. And I think there were some nice slides this morning that Louise and Jenna did, which showed why. Because we actually bring together a whole lot of things, we bundle them all up and we present it on a net basis. And so then everyone goes, oh, we don't quite understand how you got into that number. And so what you tend to find is that you've got a whole lot of analysts who specialise in insurance because they do understand what you've done there. But you've got a whole lot of people who go, not touching that. That's a bit like an IT system. It sort of does its own thing and then something spits out the other end. And we're not going to invest in that because we don't understand it. So the whole concept of IFRS 17 is to make insurance accounting more like other entities. So unfortunately, it's really saying insurance as a whole is not special. Insurance liabilities absolutely is special and needs its own rules about how to account for it. But insurance as a profession, as a sector, as an industry, you are not different to everybody else. So that's why you have these changes. But fundamentally, we're trying to get back to the economics because we don't want accounting to get too far away from the economics of insurance. We want to make sure it's still at least a good representation of those underlying economics. But it does mean some differences. But the benefit, and we're actually hearing this already from users, is that they understand the new way of presenting this information. They understand the new way of thinking about what your revenues actually are. Because it's no different to anything else. It's no different to a manufacturer. It's no different to an accounting firm. It's similar principles. So, and what do I mean by that? If you think about that contractual service margin that Louise and Jenna were talking about before, that's your profit. That's your revenue piece. So it's not profit anymore. So it's actually thinking about it as revenue. So there's no other sector or industry that gets to remeasure their revenue on a fair value basis. So you always take your revenue, it's the amount at the inception of your contract, and then it's how does that revenue emerge over time. So the only thing you might do is you might impair assets that get associated with that revenue, but the revenue emerges in a way that matches with how you've provided those services. And that's what the contractual service margin is actually trying to do. So when you boil it down, there's a whole lot of stuff. Did we make the standard a bit overcomplicated? Possibly. But that's the principle of what it's trying to get back to, is that that revenue principle is the same for everybody. Okay. So one of the other things that we hear a lot of angst about is that annual cohort piece. Why did they choose an annual cohort? Well, at the end of the day, they really tried to have a principal basis to say, how should you aggregate your contracts together? And they said, well, clearly a contract by contract basis is too difficult. So we don't want you to be going down to that level. That's not how you manage your business. That's not actually giving people useful information. So they were trying to find some way of aggregating that actually made sense. And their first lot of proposals just didn't work. So, and if you think about what we've tended to do here in Australia, we've had very high level of aggregation. So we've really pretty much done it at entity levels or very much by very big buckets of those contracts. So the IASB's concern again is coming from users, because users said to them, we want to understand what the current contracts' contributions to profits actually are. Are they profitable? Are they loss-making? If it's loss-making, is it being compensated by profit-making contracts from, say, 20 years ago? How do we know what's in that really big amorphous bucket? And so that's why they went, we have to come down below and have an aggregation level that's reasonable. So the compromise was the annual cohorts. So is it perfect? And I have to say no standard is ever perfect, but it's their attempt to get something that was reasonably pragmatic that will satisfy users. So again, it's just sort of thinking about, yes, there's some method behind why they came up with all these decisions. They didn't just go out on a limb and go, you know, let's dream this up for the sake of dreaming it up. So that's that greater granularity. They really wanted to make sure that there wasn't a mix of profitable and unprofitable transactions. Because again, that's not what happens with any other industry. If you've got something that's onerous, you actually have to recognise it. And in a lot of other industries and sectors, you actually do have to do it on a transaction by transaction basis. So they are actually giving a bit of an exemption here. One of the other good things is that you actually do have similar risks for different products being treated in the same way. So we do have a concept which says, you know, like for like. So if a transaction in industry A and industry B is actually the same economically, then let's make sure the accounting for that is actually the same. So again, that's what they're trying to do, is say, well, let's not get hung up on the name of the products, the legal form. Let's actually go to what the substance of that product is doing, and then let's make sure that the accounting matches with that. So hopefully you're getting a bit of a steer. Some of the things that you might be able to say to your CEO or your CFO when you're talking about some of these changes. But the best thing for us is the international comparability. So this means that level playing field across pretty much the whole of the world, except for the US, who's always different, and possibly France, who's always a problem. I have to say, pretty much everyone else is saying, okay, yes, let's just get on. We know that this is important. And particularly the regulators, even in Europe, are saying, just get on with it, okay? We need this information. This is information that's valuable and helpful from a prudential perspective, but also from an accounting perspective. Okay, so that's why IFRS 17's out there. And again, it's just been a problem that's been around. So the joke is insurance can actually have its own driver's licence now. It's been around for at least 17 years. So time, as they say, has come. So what's our role at the AASB? Well, our role is now to make sure that we maintain IFRS compliance. So do we want to throw the baby out with the bathwater and say, well, you know, look, we liked what we had, we thought it was pretty good, where are you? It's probably not quite as good as what we want, we don't want to take it. That would mean losing the IFRS compliance for everybody. And so the assessment that we made at the AASB was, well, no, actually, even though this standard might not be perfect, it's not so bad that we would think that we would need to give up IFRS compliance. And in fact, there's actually some things in here, as we said, that's actually beneficial. Having said that, who have we got in the room? Life insurance? Life insurance? Not many. Everybody's general insurance? Or health insurance? Probably got a few public sector. So what we're hearing is general insurers go, this is not substantially different, but what we're getting is a lot of work that we have to do to go through to get to the outcome. So what we're finding is general insurers are finding this more problematic than life insurers. Life insurers are saying there's actually some benefits to this because it is actually giving us a better way of understanding what our business is actually doing. So what I would also hang on to is what Louise was just mentioning, is there is also the benefit of working much more closely with your actuaries. And again, that's also some of the feedback we've heard about IFRS 9, which was also being touched on before, is that that's helped accountants actually go talk to people who are providing the credit, so there's a better understanding and linkage of what business is actually doing. So if nothing else, I'd absolutely encourage you to make sure that you're taking that opportunity to go out and make sure that you're really invested in what your business is actually doing. So we came out with IFRS 17. Now, internationally, they came up with what was called the Insurance Transition Resource Group. And we went in Australia, okay, what are we going to do here? And I have not been a fan of having implementation groups or resource groups. My view was, okay, you needed to get on with the standard. We didn't want to hold people back from doing that. And sometimes these groups just encourage people to wait because everyone brings out all these problems. Now, I'm a convert after the insurance TRG, particularly the fact that we chose so wisely in having Anne Driver as our chair. So she's been absolutely fantastic from QBE in terms of actually running that group. And we've used that group, I think, incredibly well. So we've played our game, our politics, very carefully. So internationally, there's a whole lot of countries, particularly in Europe, that just went, don't like it, no, it's not a standard. In fact, they actually treated the standard like an exposure draft. It's like, really? And so they just went, oh, there's all these problems. And so what happens when someone comes up and keeps crying wolf to you? You go, I don't know how to deal with that. So what we made a conscious decision to do was say, okay, we're going to go with a problem. It's got to be a serious problem, it's got to be widespread, and we've got to come up with some pragmatic solutions that helps the ISB work their way through those problems. The insurance TRG has been incredibly helpful in taking all of that information and distilling it down and saying, okay, what's our really, really key issues to make sure that we're focused. And we are, if we actually go to the ISB and we say there's a problem, because we've only done it when we've had to do it, if we say it, it actually means we've got some credibility and they're more likely to listen to us. And so that's the nice part about what I'll take you through this morning, is we're actually getting our views heard, and there is a chance that we'll actually still get some changes that will be beneficial to us here in Australia. But that's, I think, particularly important, that when you're thinking about this, it can all seem so overwhelming, but the idea is always come back to what's the really key points, what's the really key issues, what's material. Don't get bogged down in the absolute specifics. Make sure you're thinking about that big picture at the same time. So what did the TRG have concerns about? Generally speaking, two main things. So we've certainly heard this morning about the issues of reinsurance. And then the second one was actually presentation, that it was just too difficult to break it down to get the specific disclosures on the balance sheet. So just, and I shouldn't say minor concerns here, but these were other concerns that we at the TRG thought, look, you know, if we can get those two main ones dealt with, that's going to cover most of the noise and most of the concerns. These other ones are ones that we can deal with and work our way through if we need to. Having said that, quite a few of those are also still going to be addressed. And if we think about reinsurance, again, you might say, well, why have we got this reinsurance problem? So I want you to think for a second, if you think about the rest of what we do with accounting, what's very similar to reinsurance for another sector? And you might also be doing it for other things. Did I hear hedging? Is reinsurance really a bit like hedging? Okay, so under IFRS 9 or AASB 9, what do we do with hedges? Do we actually put the hedge together with the underlying transaction and account for those together? No. So that's why the AASB and ISB was saying, okay, reinsurance actually needs to get accounted for separately. And why would we do that? What's the key point of having reinsurance separately? Has it got exactly the same risks as your underlying insurance contract? No. So there's different risks, isn't there? Because it's actually with a different party. So if that party fell over, which you hope wouldn't happen, but if that party fell over, your underlying transaction still has to go on. And so when you net all those things together, you don't really have a great picture about what's going on in terms of where your real risks and exposures are. So that's why they're actually in two separate buckets. But do we think that we actually have got the accounting quite right? No. No, we think the outcome isn't really reflecting the underlying economics. And if you do follow some of those hedging type principles, then we should get better matching, particularly if you've got to recognise an onerous contracts loss up front. If you know you've already got that reinsurance benefit there, then really we should be trying to get a better linkage between those two. So that's what we're actually trying for. How well did we go? So just very quickly, a timeline. It's hard to believe that the standard's actually been out since May 2017. But it didn't take long for people to start going, oh, there's some issues. So October 2018, the ISB started redeliberating and thinking about some of the issues that were being raised. Our TRG didn't wait. We jumped in and we said, okay, let's tell them of those issues that they're considering, which are the ones that we think are genuine issues that need to be addressed. Because again, we don't want overseas parties actually going and pushing for changes with things that we're actually already happy with. So that's what we did in November 2018. So we had four main areas there that we thought were quite important. So reinsurance, locked-in rates, which we kind of, they were never going to get, but anyway, the premium allocation approach and business combinations. So we raised those, and then the ISB came out in June with an exposure draft. So what happened there? So again, we were pretty much on the money, and so the things that we'd asked for pretty much got addressed, with the exception of the locked-in discount rates. And the reason why we're not ever going to get any change on locked-in discount rates is because of that discussion I had at the beginning about the CSM and revenue. They just see CSM in a completely different light. They see that as the revenue from the contract. So they don't see that as a fair value measurement. In one of the, probably 2 exposure drafts ago, they actually did look at fair valuing, but the feedback was that's too hard, too onerous, don't do it. So at this point, it's not a full fair value standard, as our current standard actually is. So they did come up with proposals to make changes around reinsurance, but again, they haven't gone quite far enough. So once again, we're going back to actually say to them, look, please, can you expand it? So it's not just for proportionate contracts, it's actually all reinsurance. And the nice part was the TRG actually developed a model and some draft wording that they could even use. And the good news for us is that the AASB staff have come back and talked to us about that. And also next week, we're having the opportunity to chat with them again, just to continue to push to say, we really do think what we've suggested here can work in practice, which again was, I think, why Jenna was mentioning reinsurance. You can't stop your implementation projects, but do keep across what's happening in this space. So we've touched on locked-in discount rates. Accounting estimates in interim reporting, they weren't really proposing any changes in the ED that came out. And then there was a whole raft of things that we'd actually agreed with, which was good. So the IASB themselves have just come out and redeliberated at the meeting last week what they were going to do with all of the submissions to this last exposure draft. And the good news for us is that, with the exception of locked-in discount rates, everything on the wish list is actually open again for conversation with the IASB. So that's sort of good news and bad news. So the good news is, yes, we might get some change. The bad news is, again, it means we're not quite sure where that timeline is for when this standard is actually going to be completely locked down. So the last word from the moment is they're still anticipating that they will get through the redeliberations in December and February board meetings, and they're hoping to have the final changes through to the standard by June. So they're saying first half of next year. And frankly, if they don't do that, then there's absolutely no chance, I think, of that effective date, even with 1 year deferral, being achievable. And I suspect that's why they've actually put the effective date back on the table again. So there is still a possibility you might get an extra year of implementation. Okay, straw poll. If you got an extra year of implementation, would you start your transition at the same time as you'd anticipated now, or would you just put your project off for a year? Put the project off for a year? Wrong answer. Okay, so yeah, that's my kind of experience. Is it every time you give people an extra deferral, it just means everything gets squished into the last 6 months instead of, it's not a year and 6 months. So unfortunately that's human nature. So it'll be interesting to see where they go. But my personal message to you is please don't wait, just keep going, don't stop. And I'm sure all the audit firms in the room would also be saying, please don't stop. Okay, so we talked about reinsurance, so that's good. So interim financial statements is also back on the agenda again, because we found here it could be quite complex for people having to change some of their assessments or not being able to change some of their assessments if they've had to do interim reporting. And then because of the way the standard was working, so we think that would be quite good for them to come back and look again. And again, you can see the way the IASB's picked up on these topics is where we've been able to provide some new information and say, look, here's something that you didn't think about the first time when you were considering this. These are the areas that have actually been picked up and are going to be reconsidered. If you just keep making the same arguments over and over again, the IASB's really said, no, look, sorry, we've already discussed this and made this decision, because it is a standard. So it isn't an exposure draft as it currently is, it is a standard, which makes a big difference. Right. Right, and it's also good to see accounting treatment and policyholder taxes applying IFRS 17 got added into the mix, and that was as a result of Australian submissions. So it was absolutely fabulous that there was a whole lot of you in this room who actually made submissions directly to the IASB as well and didn't just rely on the TRG to pull through all the issues for you. So the more that you do that, the more chance there is on any particular topic to make sure that we know what's going on. Okay, so good news, pretty much we know what's happening. Okay, so out of all of that, where are we still at? Okay, so there's still some risks. So there is still some risk that Europe might not endorse this standard. I think with what the IASB's actually done, the approach they've taken, it's much, much harder for Europe to turn its back on this standard. So I am quietly confident that it's really just an endorsement process now, that they will actually continue through with that. And certainly we know that major players in our region, like Hong Kong and Korea, are already implementing this as well, and in fact probably don't want as much change as what the IASB might be going to make with this ED. So certainly for our region, and New Zealand of course has also picked this up, we're saying just get on with it. Canada of course is another one that's also saying get on with it. So I think slight risk, not a big risk, but whatever we can do, particularly, does anyone here work for international or have international affiliations? Yeah, so whatever you can do to talk to your counterparts going, you know, fair value, it's not the end of the earth, it's really not a devil. It does, you know, you can actually cope with it, would be really helpful. I'm just going to touch on, there's also some presentation changes that are being proposed as well. So it'll be good to have you think about that at the same time as what you're thinking about in terms of your new presentations. But I think it's very unlikely. The feedback that we've had from users is that they do actually like this standard. So does it do everything that they want? Probably not, because as we said, no standard's perfect. It's always a compromise. But they are much more comfortable with where the disclosures are with this standard than what they are with the currently one. It is also obviously going to be cost, so there is still a lot of cost involved. We do what's called a regulatory impact statement, so where we try and assess what that cost is going to be. I'll tell you that's quite a challenging exercise to do, and no doubt it's also exercising your mind. So I would encourage you to take this opportunity though, to not just think of it as an accounting standard, but to think of it, it's an opportunity to think about how can I improve my systems, how can I improve my internal reporting, how can I improve my interaction with other areas of the business. Because if you just go in thinking this is a compliance exercise, then you will end up with cost and the benefits aren't going to be as great as if you've thought about it on a more holistic approach. My lessons as a standard setter is that advocacy is most effective when you've got the prioritised issues, so you're very clear about what your important issues are. Those suggested solutions balance both the technical and the pragmatic. No point being theoretically pure, but you can't possibly implement it. That's just not helpful to anyone. It's how do you get that balance? That's really important. Evidence and extent of the impact of the issue. That's what I think the TRG has done particularly well in going back to the IASB, in being able to say, here's another area that you haven't thought about. This is a big sector, or this is a big type of product, and giving some clue as to why that's material. Because that's, as a standard setter, that's invaluable. Because it's really hard when people just come at you and say, I've got a problem, I've got a problem, I've got a problem. And then you sift through it and you go, okay, so there's 2 companies that have got this problem and it's not material. So you want me to go and spend all this time and effort fixing this problem for this issue. Whereas if you can come and make the case, there's actually thousands of us, the impact is this, users are telling us this, that all adds together to make the case that actually, yes, you need to address that. And that's, so when you're coming to talk to us about anything, if you are following these same sort of principles, you're more likely to get change and what you want than if you haven't been able to make that particular case. And as I said, absolute blessing in picking the right chair of the TRG. So that's my lesson going forward, is make sure that you get the very best people on the job. And the whole of that TRG has been fantastic. So also worthwhile commenting on the fact that with that TRG, we did try to bring together everybody that we thought would possibly be interested. Because we have been incredibly lucky in Australia that when we brought in those new insurance standards, we actually had insurance, accounting, tax and prudential requirements all pretty much aligned. Pretty unique. And so the last thing we wanted to do as a standard setter was come in and go and really disrupt that without having tried to make sure that all the pieces aligned here again. So we have, on that TRG, got representatives from the ATO. We certainly have representatives from the Institute of Actuaries, and as broad a cross-section of people as we possibly can. So there's general insurers, life insurers, health insurers, public sector insurers as well, because we wanted that open debate and having everybody's perspectives thought about at the same time. So the good news for us is that we are going to continue with that TRG for the next couple of years, I would expect, and even through until we start to do a post-implementation review of the insurance standard, which will be at least 2 years down the track, assuming we actually get to implement it. Okay, so that was insurance. Don't want you to forget about what else is happening. So there is what we call this project called primary financial statements. And this one is, again, so it's not, it's going to be applicable to everyone. What it's trying to do is it's trying to say there's some real problems in the way people present, particularly the profit and loss statement. Quick question, whose company provides something called an underlying earnings number or something that's different from your statutory profit number when you talk to your investors? Whose company has an underlying or different type of profit earnings? Goodness, I can't believe that. Okay, well, let me just say, you are unique if that's the case. So in all the other sectors, what we find is that statutory profit gets a tiny little mention and everyone else is talking about banking industry in particular, cash earnings over here or something else. So what that means is that financial statements at the moment are not telling a complete picture. So management feels like it needs to provide other information. So what the IASB is trying to do is actually provide some guidance around that to say, if you're going to do that, okay, but there's got to be some rules. And those rules would be pretty similar to what ASIC already has here in Australia, which says you need to make sure that you reconcile that, you give equal prominence, and you are not cherry picking. Nobody here would cherry pick, and telling the best story that, that can be instead of being even-handed about what's going on. So that's what this project is doing. But it's also having another look and saying what should be on your balance sheet and your profit and loss statement. So what it's going to try and do is work out a little bit more clearly what's operating. Because again, that's what people are trying to do with these underlying earnings numbers, is try and say, here's the picture of what's going to happen going forward. So that's what's going to happen from an operational perspective. So they are going to have different disclosures depending on what sector you're in. So they are looking specifically at insurance and banking and finance. So really important that you're following this project, because we want your input to see have they actually got it right in terms of what they're proposing for what should be on the face of your P&L. And also because you're going to have quite a big disruption from how you've normally disclosed, we don't want you to have to do one jump and then another jump quite quickly after that. So just make sure you're watching this project. Having said that, I do feel like the direction of this project is the right direction. It's actually getting back to something that users, I think, will find very easy to understand. But we don't want to stuff it up, is really the bottom line. And so your input's going to be particularly helpful. Okay, so what's next? So hopefully we get the finalisation of 17 in 2020, hopefully by 30 June. And 2022 is the expected application date if they do the 1 year. Obviously, if they do 2 years, you'll get an extra year. What do we need to do? So we obviously need to pick up and monitor and see what those final changes are and make sure there's no deal breakers in there. We need to get out the exposure draft on primary financial statements when it comes out. And we'll obviously be providing feedback and doing a submission on that. So let us know how you want to be involved in that process. And then, as I said, we'll keep that transition resource group going because we want to make sure that we're continuing to support this sector. And I think that's been doing a great job. So I would encourage you to make sure you know how to get in touch with any of the members of that, which is all up on our website. And Helena, where's Helena? Helena's here, so if you want to talk to her over the next day or so, if you're interested in being more involved with that group, then please talk to her. And lastly, we want to make sure that we're actually supportive of everyone else adopting 17 as much as possible, because that's in our best interest. We don't want to be an outlier here in Australia. As I said, there's not really a risk that that's the case. Our perspective is that we've been leading the push quite well. What do we need you to do? So use your contacts, push, get it endorsed overseas as much as you can. We have a weekly newsletter, so please sign up to that to make sure that you're following what we're actually doing. Don't stop your implementation programs, please. Just keep going. And make sure that you're leveraging your experience. So we love to hear what's going on with you. So if you have got issues, TRG is a good way, but always just feel free that you can pick up the phone and have a chat to us. In particular, we love examples. Examples are fantastic in trying to understand how things are working or not working. So the whole message here is just as much as possible, be involved and keep us informed about what you're going through. We are interested. And once we get this standard finalised, as I said, there will in fact also be a post-implementation review 2 years down the track as well. So again, we want to keep collecting those experiences so that if there's some final tweaks that are needed in 2 years' time after that, then obviously we know what those things are. Right, so all I can say now is good luck. Thanks, everybody. Do you have some questions?
I'm sure your newsletter now is going to get a massive uptick in the number of readers signing up. So
I do hope so.
Look, there's a few questions that have come through. Some of them are fairly specific, I would say, that are going down into a particular disclosure sort of path. And so I've saved some of those. Probably for Hayley when she sort of comes back, because she's doing a specific disclosure section later on. But we'll, I've saved one or two. So the first question, while we're sort of pulling up Slido, was around any update on application to public sector entities.
Oh yes. So in terms of the public sector, so at the moment the standard applies to for-profit entities and the not-for-profit private entities. So with the public sector, we put out an exposure draft which was proposing to bring in anything that looked and felt like an insurance contract. So the difficulty in the public sector is that a lot of their requirements are actually brought in through statutory requirements. And so 17 is actually all based around having a contract. So if you don't have a contract, some public sector entities have been arguing that they don't fall within existing AASB 1023 or 38. So what we were trying to say is, okay, look, it doesn't matter whether it's a contract or a statute that's brought in the requirement. If your risks are the same and it looks and feels like an insurance entity, then we want to make sure that you're also following similar accounting. That's that transaction neutrality principle. So we put out an exposure draft. So we got some feedback back. It's just that we've had a few other priorities, so we haven't actually had a chance to get back. Our biggest issue is, frankly, whether or not NDIS or something like that actually falls in it as an insurance contract, or whether it's really more of a social benefit. So we've got to try and find this line that says, okay, if you're on this side, you're insurance, and if you're on this side, you're a social benefit. So it's a little bit tricky. So we want to make sure that we take the right amount of time and actually get that line in the right spot. So watch this space. We'll be telling you a bit more about what's happening with public sector and what the next steps are over the next little while. But certainly if you're in that space, we want you to keep talking to us so that we know what your particular issues are. It's also likely we'll do something with New Zealand, because New Zealand also is looking to work out what to do with their public benefit entities over there as well.
And then were a few questions around sensitivity around commercial data. And so then particularly around disclosure of saying, well, look, if you're disclosing too much information around onerous contracts, how do you strike the balance between releasing information that might be commercially sensitive? Do you have a view on that?
Look, that's always one of the challenges with accounting standards, and we do hear that. So there's always ways of disclosing information, but I do think onerous contracts, there is an obligation to disclose those. So again, if you're a listed company, you've already got some continuous disclosure obligations. So if something's really fundamentally a problem, then one would hope that you're already talking to the market about that in any case. So what we do with accounting standards really shouldn't be a surprise. But yeah, so do appreciate that sometimes that can be quite challenging getting that balance right. But that is why the standards have principle-based disclosures to try and give you a little bit more flexibility in terms of how you might meet that disclosure requirement. So there's always different ways. So, you think about ranges might provide some of the specific information that you need to get across rather than specific contracts, etc. So I'm sorry, there's not a great answer to that. Having said that, there has been some past regulator action by ASIC and other areas where companies have argued that information was market sensitive and they shouldn't disclose it. That tends not to go down too well with the courts. So it is something that you will need to actually think quite carefully about. But if you've got specific instances, we're obviously happy to have a chat and at least make sure that we're aware of what the particular issues are that are coming out.
Linked slightly to then, there's a question someone's just sort of lodged in which says, will the AASB be providing an idiot's guide to IFRS 17? Have you started drafting that already?
No, we don't think that anyone here is an idiot, so of course we're not going to do that. Look, to be honest, so the IASB has actually been doing what I call a fantastic job in doing lots of podcasts and lots of quite simple examples that are coming out. So if you haven't already, I would actually sign up to their newsletters so that you know what they're doing as well. I guess here in Australia, what we've tended to do is leave the training for the for-profit sector to the large firms. So we haven't specifically come out with what I'd call a simplified version of the standard. So we'd be taking you back to really what the IASB's materials are. And again, I think they're doing a much better job in terms of having quite useful examples and illustrative guidance, etc. And don't forget with them, also you get the TRG outcomes from what's been discussed already. But not thinking about specifically insurance, don't forget the IFRS rejection decisions and what they're doing, because they actually now have some really great examples where they, instead of in the past, they used to just say, look, the answer's clear, everyone knows how to do it. And everyone go, no, we don't. What they now do is they actually step you through how they get to the answer's clear. So they're actually quite useful. So always make sure you're looking at what IFRS actually put out now, because that's quite helpful in terms of stuff. Not that there's anything specific on insurance. Keep us informed if there is a need, if there's something particularly Australian specific that we think, or you think that we should be looking at in terms of extra guidance, then obviously let us know, and we'll have a look at that.
And the last one, because I don't want to be holding us up from lunch.
No, most important.
But there were a few themes in some of the questions that came through about people obviously being concerned about where they might have a parent company in a different jurisdiction offshore, perhaps in the US, or so you mentioned the French being problematic, or somewhere else in the EU. If there then becomes a timing difference between the IASB's of choice and then sort of EU approval, is there any view around relief or a sympathetic approach from the AASB related to that matter?
Look, it hasn't been specifically discussed by the board, but again, that would be something, if that does turn out to be problematic, then certainly let us know, because there may be some things that we can do. Our goal is always to make sure that everyone can claim IFRS compliance that's got public accountability. So anyone that's listed, we're absolutely, that's our goal, is that they have to be able to claim IFRS compliance. But if we are talking about entities underneath, then look, it certainly would be worth coming to the AASB with the issue. But what did I tell you about advocacy if you're going to come to the AASB with that request? So you've got my 4 pointers. You need to make sure that you could give us some ideas about the extent and nature of what that issue actually was, and make your argument as to why we'd need to spend some time dealing with that. Okay.
Thank you, Kris.
Okay, thanks everybody.
Appreciate it. Thank you.